Hi, everybody. This is Josh Jalinski, the financial quarterback. We're talking about infinite banking exposed today, inflation and stocks. We are live on YouTube, Clubhouse, WOR, and answering all of your questions. If you need help navigating this uncertainty in the market, we'd love to hear from you. We're going to be talking about stocks, bonds, mutual funds, whatever question you have. No question is a dumb one except the one that you do not ask. Market down nearly 3%, 2.61 on the S&P, 2.41 on the Dow, 3.24 on the NASDAQ. We're talking about the CPI release, NASDAQ down. And we have a real problem as inflation does not look transitory, but indeed looks permanent. But before we do that, I want to talk about infinite banking exposed. A lot of people are talking about infinite banking. Some people call it infinite spanking. Actually, I'm the only one who calls it infinite spanking because nobody really talks about it. But there is let's go to the board. So we're talking about infinite spanking or infinite banking. Where's my stylus? Do you have the stylus, Jim? If you get me the stylus. Where'd it go? Okay, here we go. So we're doing a whole expose on infinite banking. We're calling it infinite spanking exposed. Now, infinite banking is everywhere. It's all over TikTok, all over YouTube, and so all over wherever you can find out. And essentially, we're going to expose it today. First off, what is infinite banking? Then is it good or bad? And what can we learn from it that maybe you should be worried about with your money? So number one, infinite banking is when you overfund a whole life policy. So WL stands for whole life. Now you might say, well, I thought whole life was bad. Well, we're going to talk about the pluses and cons. There are also people who do infinite banking on universal life or indexed universal life. So essentially, we're talking about infinite banking exposed today. We're talking about inflation. We're talking about stocks, the economy, macroeconomics. We'll answer any of your financial questions today. So I'll talk first about infinite banking as it relates to whole life, and we will define it. So essentially, when we're talking about infinite banking, basically, let's assume the premium is on a policy, you have a premium. So let's say your premium is $10,000 a year. What infinite banking says is you need to put money towards the paid up additions rider, which is also called a PUA. And you essentially overfund a life insurance policy as some sort of tax loophole. Well, there's no real loophole in it. It's just that according to Section 7702 of the IRS, and there's different internal revenue codes, that the cash value inside of a life insurance policy, also known as CVLI, grows tax-free and can be pulled out tax-free via withdrawals up to basis and then policy loans. So let's assume you put in $100,000 into a policy over 10 years, and the cash value grows to $120,000 over that 10-year period. You could withdraw up to $100,000 with no tax, and then loan the remaining $20,000 with a policy loan that's tax-free. Now, when you pay for a loan, you have to pay interest, just like you would pay interest with any other type of loan, like a HELOC. So think of it as a line of credit against your policy. So I'll go to that in a few minutes. Okay, so basically, assume you've put in 100K over a 10-year period. Your premium was 10K for 10 years. Your cash value is 120K. Your basis, that's the money you put in, is tax-free because it's already taxed money. If you take out the difference between the cash surrender value and the basis, if you just cash out the policy, you pay ordinary income tax. But if you take 100 grand as a withdrawal, that's tax-free. If you take an extra 20K as a loan, that's tax-free. Well, what's the negative? Generally, there's an interest rate. We're going to assume it's 5% just for round figures. So if you loan out 100, you'd pay 5,000 in interest. That would accrue on your policy. You don't really have to pay that loan back. A lot of people get kind of a misunderstanding with this. Now, eventually, if you don't pay it back, the policy could blow up. So you have to be wary of that. So we've talked about what it is. It's the overfunding of a policy so that you can essentially loan money out as a bank to buy cars, to pay for vacation, and you have the protection. Now, here's the thing. I don't know why we need clever titles. Maybe it's clickbait, like infinite banking. But to me, it's kind of a misnomer because you don't own a bank, right? If you own a life insurance policy, you own a life insurance policy. You don't own a bank. So I don't know why it's called infinite banking, but you don't own a bank. So I think it was originally titled by a guy named Nelson Nash in a very interesting book called The Infinite Banking Concept. So Nelson Nash wrote this book. A lot of people are running with it, selling life insurance policies to people expecting to make a great rate of return. I want to be clear here. Policies, a good whole life policy has a dividend of 4, 5, maybe 6% at the absolute highest right now. You buy a dividend paying whole life that is participating in the profits of the company. They pay dividends, you're participating, and they cannot cancel you so long as you pay the premium. But I just think it's a little bit overhyped right now. Nothing against the strategy. I'm a big believer in utilizing cash value life insurance. Why am I a big believer in it? Because it's a nice conservative place to grow cash. It is non-correlated. So let's talk about some of the benefits. It is benefit number 1. Let's go over all the benefits. Benefit number 1, it has a death benefit. Benefit number 2, it could have living benefits. I'll get to what that means. Essentially, when you have a policy, it's not just good if you die. It's also good if you live. But things can happen if you live. Problems can occur if you live. What are those problems? Well, you can have a critical illness. So if you have a heart attack, some companies, they just give you a check for $25K. You need a stent put in, $25K. You have a triple bypass. Jim, or what do you have? You had 6? Thank God you're okay. But if you had one of these policies, Jim, they would have written you a check for $25K. Not bad, right? Tax-free. That's a living benefit. You don't have to die. Also, number 3. Now, there's also other benefits. Critical illnesses, you don't die, but you have a stroke, cancer, heart attack, blockage, something major like that. Does that make sense? Benefit number 3, disability. So let's say you're out on disability. So you get disabled. So you have a disability. You have a heart attack, stroke, cancer. And the boss says, hey, you got to go on disability. We can't keep paying you what you're being paid. What would happen? Well, you get the state disability, which, I don't know, it's like $2,500 a month if you're lucky. Do you happen to know what it is, Jim?
No.
Did they give it to you? They didn't even give it to you. They didn't even give it. They didn't even give it to you, because Jim was a trooper. He hung in there. Hey, you took.
Can't let the business fall.
Jim couldn't do it, so Jim, you got to take care of yourself. But it's tough because you can't really live on disability. So what it provides is they will pay your premium in the event of disability. Jim's very dedicated, but you know what? Whatever the state pays you on state-run disability is typically not enough. So we mentioned disability benefit, living benefits, disability benefits, meaning if your premium is $10K a year, they will pay your premium in the amount of $10,000 a year. Not bad. So, in the case of Jim, if he went out on disability, they would pay him 10 grand a year, and they would have paid him 25 grand just because he had it. Not going to make you rich, but it's not a bad benefit. Disability benefits, living benefits, disability benefits. Also something called cash value. That could be used for college. Could be used for whatever reason you want. You want to buy a trip to Hawaii. Now, the negative is the loan interest may erode the policy. You don't want to overloan, but it's available for you. So far, those are the 4 big benefits. What are some other benefits? It bypasses probate, which means if you die and creditors come after your estate for medical bills, they can't take it from the life insurance policy. Or if the life insurance is owned by a trust, they can take it, though, if you leave a will. So we got 5 key benefits right now. It is creditor protected in some states. So check with your attorney. So that's 6 benefits. There's some more, but just to be simply put, also you could get in some income for life when you're retired as a retirement stream of income that's tax-free like a Roth because it's deemed a loan. So you got a lot of options with infinite banking, a lot of pros. These are the pros. What are the cons? Well, generally, it's the salesman. It's always how it is. People sometimes lie. They oversell. And you know what? I thought all those benefits were pretty good. You don't really need to oversell it. How is it often oversold? Well, people will say you can make a lot of money every year. It's pretty mediocre. It's generally going to pay you a dividend of between 4 and 6%. And some people will say, well, that means I'll make 4 to 6. No, it means your dividend rate is 4 to 6. It doesn't mean make 4 to 6 every year. But it's a nice conservative way to grow your money, what some call uninterrupted growth. A lot could be said for that. Why is uninterrupted growth good? It's forced savings. That's another benefit. People are using the market crash of today to divert them from their goals. So generally the problem with this strategy is that people over-promote it. I've heard people really sell this on TikTok or other financial misinformation tools. And it's generally a form of index UL. Now, IUL is not bad. IUL stands for Fixed Indexed Universal Life. But some people will say, oh, you make double-digit returns with no losses. Well, that's what happens to your interest credits, maybe, but there's also cost of insurance. So you just have to be aware of that the cost of insurance could eat up the policy. And generally, it would take a 10% return down to, 4 to 6, similar as the other ones. But you got to realize you're paying for a death benefit for your family, for your loved ones. Some people are there at a funeral with flowers. I'm there with checks for clients, for those who need help with their finances due to the foresight that their, father or mother, whoever leaving the death benefit did for their loved ones. So essentially, it's more the hype, and that's why I call it infinite banking, because it's not that infinite banking is so wrong. Like if you need money for buying a property, here's what's kind of cool about that. You could loan money out against, let's say you have 120 grand. Let's say we have a market crash and you can buy a piece of real estate with 120 grand. You can then loan that money out against the policy. Let's go to the full screen. You're going to loan that out, and let's say you have a 5% interest charge. Well, that's a write-off because you're using it to fund a business venture, a house owned by an LLC. And maybe you can buy that house cash from the bank, and it's a $200,000 house, and instead of going to a hard money lender, you can actually go to yourself. So real estate investing and life insurance go hand in hand, because if a bank is not willing to give you money, a life insurance company will. So if you're just joining us, we're on Clubhouse, we're on YouTube. So type in the chat box if you have any questions. Jim, if you could look at the chat box in YouTube. If you're on Clubhouse, type in your question. We're going to take a short break for the first segment. And when we return, I'll be back with your questions on all matters financial. We're talking inflation. We're talking about infinite spanking. We're talking about Roths and more. This is Josh Jalinski, the financial quarterback. Don't touch that dial. And we're back. This is Josh Jalinski, the financial quarterback, inviting you to call me right now at 888-988-JOSH. I would love to take you through a tour, 45-minute tour of our powerful wealth creation tool called the Protection Savings Growth Model. That gift, it's literally a wealth blueprint, a blueprint on how to use your money. So give us a call now, 888-988-JOSH. If you have questions on stocks, bonds, annuities, mutual funds, whatever question you have, no question is a dumb one except the one that you do not ask. So we're answering all your questions on money. The markets are reeling. Inflation is going up epically. The market ended this week in the red. S&P 500 down 2.91%. Dow down 2.73%. NASDAQ down 3.52%. And if you want help navigating, what to do with my 401k, what to do with my 457, we're there for you. So I'm going to do a little technical analysis in the stock market. It's always fun to do charts. And we're going to do some TA in the market. I'm live on YouTube where we're going through different charts. I'm going to do a 5-day chart. If you look, the market, as we say, just had a trap door to hell. Basically, all of a sudden this morning, due to the CPI numbers, boom. And this chart does not look good. But here's where we're at, folks. If you look at the 6-month chart, we're getting a series of lower lows, right? And we're getting a series of lower highs. That's very bearish. Things do not look good. But could be bullish, right? If we hold at 3,900, we were at about 3,900 a few weeks ago when Scott Minerd announced Summer of Pain. Then boom. So this was the Summer of Pain. And then all of a sudden, we had a rally where we had a 7% rally in like 3 days. And then boom, 7% drop in like 2 days. So do we open up Monday a little lower? So I'm looking at, and you could look at different charts. We could do a daily. We could do a 30-minute chart. We could do a, weekly chart. Do a daily. If we look at the daily chart, basically we are at the low of May on the SPX. So what I want to see is the market rally off the lows like we saw in 519. If not, market looks kind of oversold. There was actually a stat I read that 85% Michigan consumer sentiment survey is negative. So folks, if you look at the chart, there's some definite negative charting. And again, if we look at, can I draw on here? I don't know. So if you look at this chart, kind of a negative trend line. Are we looking, could we have an uptrend? Well, I don't know. Right now it's a downtrend line. So we shall see. So right now the trend is clearly down. If you look at, do another line, basically things are not looking good. So classic kind of bear market, lower highs, lower lows. But things could change, right? Things could change in an instant. So if you have a financial question, raise your hand, chime in. We're going to go next to Will, who has a question. Go ahead, Will. You're on with Josh Jalinski, the financial quarterback, taking your questions on all matters financial. Go ahead, Will. Okay, we'll get to Will. Bringing him up. Okay, so basically, the S&P chart doesn't look good. If we go back and we look at the 10-year Treasury chart, as evidenced by symbol TNX, I just go to Yahoo Finance. You know why I go to Yahoo Finance? Yahoo Finance. It's simple. It's kind of easy to understand. Yields are soaring. If you look at a 6-month chart of yields, they keep going up. Interest rates are going up. That means if you bought bonds, they are going down. So you could tie your money up for 10 years with the government, get 3.15%. So if you look at the 52-week range, this is pretty much near the high. That's a very bearish sign right there. So we'll take your questions on all matters financial. If you have questions on stocks, bonds, annuities, mutual funds, no question is a dumb one, except the one that you do not ask. So we're talking about treasuries now. We talked about the SPX. A critical number that I want to see us break to be very bearish. If we break 38.50, 37.50, we may see 34.50. It's another 10% decline from lows. It could be very reasonable occurrence. So we're going to go to the lines. If you have questions, give us a call. We'd love to hear from you if you have questions on stocks, bonds, annuities, mutual funds. So JC, do you have a question on the markets? Go ahead. Okay, next up, we're taking your calls on all matters financial. If you have a question, 800-321-0710. We're here for you. If you have questions on stocks, bonds, annuities, mutual funds, whatever question you have, no question is a dumb one except the one that you do not ask. So we are here taking your questions on all matters financial. Ping in your friends. We got a lot to talk about, but I always want to hear from you. If you have questions on stocks, bonds, annuities, mutual funds, we are answering all of your questions live. So in this segment, we'll talk about Roths. We'll talk about 5 ways an excess IRA contribution can happen. And here's how to save $1 million for retirement on a $60,000 salary broken down by age, and why saving in a 401k plan may be tough if you are a frequent job switcher. So we'll talk about Roth IRAs, talk about the market, we'll talk about whatever questions you have when we return. But first, give us a call, 888-988-JOSH, and get my free book, The Retirement Reality Check. Call us now, 888-988-JOSH, when you schedule and keep your no obligation review. So coming up this hour, we're discussing one Roth IRA bucket, 5 ways to make an excess IRA contribution happen, how to save $1 million for retirement, broken down by any age, and why saving in a 401k plan may be tough. We'll be back after these messages. This is Josh Jalinski, the financial quarterback. Don't touch that dial. And we're back. This is Josh Jalinski, the financial quarterback. We're talking about your money and really whatever question you have. No question is a dumb one except the one that you do not ask. So we're talking about anything that you want to talk about with your money. So we're also going to break down some history of the markets. So if you have a question, now is the time to chime in. So let's say you own multiple Roth IRAs and you believe it is necessary to maintain all these accounts to keep things properly organized and to track your 5-year conversion clocks. Let's say you contributed a Roth IRA number 1 for over a decade. Then you do another partial Roth conversion from a traditional IRA many years ago. You get a Roth 2. Then you have another one. So let's say you have all these various IRAs, you have all these various Roths. So I'm going to give you one Roth IRA bucket clearly defined, strict ordering rules, and no need to maintain separate Roth IRA accounts like John if you don't want to. The IRS sees everything. So John was a real anal guy, so he kept everything separate. So we're going to label these accounts traditional IRA 1, traditional IRA 2, Roth IRA 1, Roth 2, Roth 3, Roth 4, Roth 5. So you might have 7 accounts. The IRS will only see 2, your traditional IRA dollars and your Roth dollars. So the way he's, combined it was, he said, I'm going to keep one IRA for my partial Roth conversions and another IRA that only will include pre-tax dollars. And then these other Roths, by the way, I do believe if you have post-tax IRA money and pre-tax, you should keep that separate. It's very easy. It's way easier. But in this case, he had contributions and earnings. He had one created by a first traditional Roth to IRA conversion, then a second. So he was keeping them all separate. So how does the IRS keep things straight? How do they know what is Roth contributions and what is conversions and what is earnings? Tax forms, well, Form 1099-R and Form 5498 tell all. Through these tax forms, the IRS can track you. They know what went down and they know what's up. If John takes a distribution from any of his Roth IRAs, what will that distribution consist of? Based on strict ordering rules, the first dollars out will be contributions, then conversions, then earnings. Even if John does another conversion today, generating Roth IRA number 6, because he's really anal, keeps everything separate, then take a small distribution from that same account tomorrow, it will be considered a withdrawal of contributions. But how is that possible? Once again, the IRS does not care how many Roths you have or how many you maintain. They only see one bucket of Roths under your name. And that bucket is clearly separated into contributions, conversions, and earnings from those forms. Assume John contributed $50,000 to Roth IRA 1 over many years. This means that every custodian would generate a 5498 and report to the IRS in box 10 Roth IRA contributions. What if John then did a total of $200,000 in conversions? Those conversions would also be reported on a 5498. What about his Roth IRA conversion amount? Roth 3, box 3. Additionally, each 5498 is essentially time-stamped to track the 5-year clock. Basically, on a Roth, you have a 5-year clock that you need to keep track of. And we can help you do that. So, generally speaking, you don't need to be as anal as this guy. Give us a call, 888-988-JOSH, 888-988-JOSH. We're here for you if you have questions on stocks, bonds, annuities, mutual funds. Now, segment 2, you can have too much of a good thing. While saving for retirement with an IRA is a good strategy, there are limits. Everybody's got their limits, and so does your IRA. When a contribution is not permitted in an IRA, it is an excess contribution and needs to be fixed. Here are 5 ways an excess IRA contribution can happen to you. The good news is that excess contributions can be corrected and often without penalty. For the right fix for your situation, be sure to talk to a knowledgeable tax and financial advisor. So we're going to go to the phone lines, and we got Will, who has a question. Also, JC. JC, can we hear you now? Go ahead.
Hey, Josh, thanks. I just wanted to kind of go off the cuff and just wanted to see from a regular Joe's point of view on the possibility of Shanghai actually shutting down again. And as a regular consumer over here at the U.S., how's that going to affect us? And, what do you think we can expect moving forward, considering, the direction we're heading with the reports that came out today?
What do you mean by a shutdown?
Well, that's what I mean on Twitter. That's what the word was. There's another COVID scare, and they're shutting down Shanghai again, and that entails, more supply chain issues, right? The ports shutting down. I mean, I'm not really sure what logistics that affects, but from everything that I've seen and heard, as like a consumer, that affects everything all the way down to what we see in the grocery stores or just the regular products we buy off of Amazon.
Yeah, and that's certainly why we see the inflation, supply chain constraints coming out of China. I think personally we need to bring all the manufacturing back to the U.S. or at least Canada, Mexico, U.S., because this is just ridiculous. There are shutdowns. Part of me wonders if they just shut down because they see that we're weak and they just want to cripple us. But, I mean, it's nature. We really can't control COVID anymore. So I don't know why we're trying. It's one of these things where, it looks conspiratorial, but we shall see. Yeah, I think certainly, I think the big narrative of why the market dropped this week is the 10-year Treasury is over 3%. That's signaling fears. The Fed is rolling bonds off of their balance sheet. No one wants them, so it's causing those rates to go up. The 10-year Treasury above 3% is not a good thing for the stock market. They're going to say it's CPI data. We knew we were going to have high inflation. Now, okay, do we want to have 8.1% or 7.9% instead of 8.3%? Sure. But I mean, we knew inflation's is here at least for another few months until the market crashes, and then we'll have a recession and deflation. And the market's already down significantly. So I'm taking your calls on All Matters Financial. If you have a question, now's the time to chime in. I'm Josh Jalinski, the financial quarterback. We're live on YouTube, WOR every Saturday, Sunday at 9, and Clubhouse. So invite your friends to listen. We're here for you now. Next up, we're going to go to David. David, do you have a financial question?
No, I'm good, bud. Just listening in. I appreciate it. I enjoyed your conversation with Breedlove.
Oh, thank you. Yeah, so, we have a YouTube up with Breedlove. He had this chair. I felt like I was at a Putin conference. It's kind of an odd set. Showed our legs. Wasn't particularly flattering of me, but it was a good interview with Breedlove. Talking about God, state, and Bitcoin. And very interesting how if there is a vacuum, GOV is replacing it, not GOD. So it's quite interesting. So next up, we're going to talk about excess contributions. If any of you have made that mistake, and that can be a grave mistake, you get hit with a penalty. So let's say your accountant tells you can put in money into an IRA or your financial advisor, and you make a mistake. you will have an excess IRA contribution more than the annual limit for the year. For 2022, you can only put in $6,000 a year if you're under age 50, or $7,000 or more if you are 50 or over. Seems like an easy rule to follow, but a lot of people make mistakes. Who is going around contributing tens of thousands of dollars to IRAs in violation of the contribution limits, especially since most IRA custodians will not accept contributions over the yearly limit? However, an individual with multiple IRAs with different custodians could exceed the limit by contributing to each of them. What I've seen a lot of people is they'll do a Roth and they'll do a traditional because they'll forget they can only do one. So mistake, number one is essentially exceeding the annual contribution limit. It's easy, 6 and 7K. The second mistake is not having enough earned income. A more common occurrence is an IRA owner not having sufficient earned income or taxable compensation to fund an IRA contribution for the year. While you can use your spouse's compensation to fund your IRA, you may not use other sources of income, including Social Security, pension, rental, or investment income. So let's say you're under a certain age, and let's say you're 62, retired, but your spouse works. You could do a spousal IRA and put up to $7,000 if they make over $7,000 or more. You may have a high income but not be eligible to also fund an IRA. If you go ahead anyway, the result is called an excess IRA contribution, and there can be an excess IRA contribution penalty. The third mistake is too much income for a Roth contribution. This is a common cause. People think they can do a Roth and then their income's too high. If your income fluctuates or if you have unexpected income in the year, you are particularly vulnerable. Watch out for the annual income limits. For traditional IRAs, there are no income limits for eligibility to contribute, so this is never a problem. Number 4, failed attempts to roll over funds. You may be surprised that a failed attempt to roll over can result in an excess contribution. Well, how can this happen? Well, there are a variety of ways you can end up in this position. One possibility would be the violation of one of the rollover rules. If you mistakenly roll over the 60-day rollover period and it has already expired, or if you violate the once per year rollover rule, you will end up with an excess contribution. This is critical. You are only allowed one rollover per year, one 60-day rollover. You can have an unlimited amount of custodial transfers, but only one 60-day rollover. And also, you can also, let's say you do the 60-day rollover and you wait till day 90, well, that's a problem. You can get fines, fees, penalties. RMDs are also not eligible to be put in an IRA. So that's another mistake, mistake number 5. Now, how can you fix an excess IRA contribution? If you're listening and you have that problem, give me a call right now at 888-988-JOSH. If you want help with RMDs, IRAs, avoiding fees and penalties on IRAs, annuities, what have you, give me a call now, 888-988-JOSH. I'd love to shake your hand, meet with you, and give you a 45-minute wealth blueprint. Call now, 888-988-JOSH. 888-988-5674. We'll be back after these messages. And we're back. This is Josh Jalinski, the financial quarterback. If you have a question on stocks, bonds, annuities, mutual funds, whatever question you have, no question is a dumb one except the one that you do not ask. So we are here live. If you have questions on stocks, bonds, annuities, mutual funds, you could have questions on Bitcoin, stocks, how much should you set aside? So we're going to give you next a tip. And there was a comment in one of the chats about why bother with traditional vehicles when you simply can buy Bitcoin and hold, considering the returns you get every 4 years. Well, good question. Well, one, Bitcoin's gone down 50% since November. So there are a lot of people who bought last year and they're down 50%. So I'm a big believer that you shouldn't have all your eggs in one basket, even though I'm a Bitcoin maximalist. So I don't think, being pro Bitcoin means you're anti diversification, anti common sense. Also, if we have a bear market, Bitcoin's going to go down with it. If stocks are down 50% from here, 30% from here, Bitcoin probably moves right now very similarly to the S&P. Now, in terms of long term, big believer in long term. But let's say you want to buy Bitcoin. Well, you can buy Bitcoin with an IRA and you get a write-off to HODL Bitcoin to increase your stack. So instead of buying, let's say you can put in 6,000 into an IRA. Now you can put in 6,000. So instead of putting in $4,000, now you can put in 6. So if you only have $4,000, you get an extra write-off on your taxes, get more money in your pocket, more money to HODL long term in Bitcoin or stocks. Now, I'm personally more of an advocate of owning it in cold storage, away from traditional vehicles. I think that's the benefit of Bitcoin. But if all you are is looking to increase your stack or increase your position in Bitcoin, why not do that with help from Uncle Sam? So I'm a big believer in Bitcoin, but in terms of an IRA, so somebody made a comment about GBTC has a significant discount. Yeah, it does have a discount. We shall see if the long-term premise of GBTC works. That stands for the Grayscale Bitcoin Trust. We're not recommending anyone buy or sell it, but it trades at a discount right now, significant discount. And the thought is if they ever go public, or if they ever make it not public, if they ever make it an ETF, those who own it could actually make a profit from that discount. But we'll see if it happens. I've been hearing that for years and it hasn't happened. So now, setting aside a percentage of your salary every month is a simple way to grow your retirement account over time. By figuring out how much your monthly contributions will be worth decades down the line, that can be a little difficult. If you start in your 20s, retiring with $1 million won't be difficult. But the older you get before you salt some money away, the larger the portion of your check you will have to put away each month. According to CNBC, as a general rule of thumb, most financial advisors suggest that you save 10 to 15% of your salary. But if your goal is to get to $1 million, the percentage that you need to invest will vary considerably based on how old you are when you start. This case study takes a look at how much you'll need to save if you make an annual salary of $60,000, broken down by the age in which you start investing. The model used here assumes that you start with no savings. And that is the point too. There are crazy talk about all these negatives in the market. You should just grow your stack. HODL stocks, HODL Bitcoin, save cash for a rainy day. People let current events derail them of just saving. And the big thing, just save 10 to 15% of your pay. I've never met anybody who saved 15% religiously who's become a failure. So we're going to go to the questions. I don't know if Will can ask them. Will has some questions in the chat box. He's talking about a backdoor IRA. So some good questions. Let's go to Will's question. Is there an analog to choking up on the bat in these sorts of financial conditions? What about the use of cash secured puts and covered calls during these more turbulent times? I understand your focus is concentrated on the big picture, long-term management of personal wealth. So that's really good. So if we look at this, let's go through to Will's question. It's actually a very good one, and I'm going to go to the YouTube. So I don't know if you can go to YouTube, but I am going to draw out what you can do personally what I'm an advocate of personally, I just have to get to the screen for a few minutes, so bear with me. Also, somebody made a comment about the backdoor Roth, and that's a very powerful concept, the backdoor Roth. And why is it a big concept? Because you can put money in a non-deductible IRA and then call your custodian and they will convert that. It's a pretty powerful concept to a Roth, and then that money will grow tax-free for life. So if you're looking at owning Bitcoin or stocks or whatever it might be, annuities, anything is a really good place in a Roth because all the growth is tax-free. So this is our model, and this is the 27-point checklist that we will go through for free if you call my office at 888-988-JOSH. So what you do is you put in $6K into a Roth, but let's say you make too much money to do $6K. You put $6K into a tax-deferred account known as a non-deductible IRA, ND IRA. Then you call your custodian. So I call Jim, who's our illustrious office manager, and I tell him, Jim, convert my non-deductible IRA to a Roth, and you only pay taxes on the growth. So if you do it right away, there's no tax on the growth. So it's a very powerful tool. So that's the non-deductible IRA. It's an excellent tool. But let's talk about the big picture, because a lot of you are worried about, what do I do with my money? Well, I have a little model here called the Protection, Savings, and Growth Review. So if you have a moat first, you should be fine. Moats consist of car insurance, home insurance, liability, disability insurance, wills, trusts, life insurance. Most people get these 9 components wrong. You know where they also get wrong? They try to do these sexy, sophisticated, safe money strategies, and they lose more. So my advice is to hodl your stocks, hodl your Bitcoin, but make sure you have a 1 to 3 year volatility buffer in the bank. It could be in cash. It could be in your mattress. It could be in treasuries paying 3% right now. It could be in cash value life insurance. It could be in fixed annuities. But if you have 1 to 3 years of your living expenses in these first 7 drawers, the first 7 drawers are checking accounts, savings accounts, credit unions, savings bonds, CDs, money markets, tax-deferred programs. That would be annuities that are fixed. That would be fixed index annuities. That would be cash value life insurance. That is your money that you could draw from that would create a volatility buffer. I generally avoid things like the questioner said cash secured puts and covered calls. You know what's happened? The covered calls will give you income. The stocks are still going to fall. Options are not foolproof. You know, there might be benefits. I generally avoid that stuff. People get burned. I have nothing against covered calls. The benefit of covered call is you get income off a stock that you don't mind holding. So I'm okay with covered calls, I guess, generally speaking. And if you don't know how to do covered calls, there are ETFs that we could show you that actually would do the covered calls for you. So in our model, which is this thing that I'm drawing on YouTube, which is the Protection, Savings, and Growth model, you have a moat for protection. You have the first 7 drawers for emergencies. You really shouldn't worry about the market. It's going to go up. It's going to go down. And this money over here, that money can go up, can go down. So you should be protected. And then you should avoid dumb debt. I mean, but realize you got to prepare for a recession or depression. Now, JC has a question on retirement. Go ahead, JC. On what is the standard amount to retire. Go ahead, JC. Okay, JC basically said, what is the standard nowadays when it comes to retirement? What amount is considered wealthy? Well, I don't know, 5 million maybe. But, you know, I think if the average person has $1 million saved for retirement, plus Social Security, plus a paid off house, most people will be able to get by on that. And you know what? If you can lower your debt and you can lower your expenses, you can get by on 50, 60 grand a year in retirement. It's tough for some people, but we shall see. So I'm going to go now to some of the stories that we were talking about. So this is the model where we verify economic decisions. And I'll show you that in a few more minutes. But first, let's talk about this whole concept of how to get $1 million in retirement savings. So we'll talk about that. So how to get $1 million saved for retirement, we'll get to that in a few minutes. Well, basically, the way you save $1 million in retirement is very simple. You save 10 to 15% of your pay religiously. You save money like a chipmunk, and you store it. But if you were 25, if you make 60 grand a year, you need to save 10% of your income. If you're 30, you need to save about 15%. If you're 35, 20%. If you're 40, you need to save about 30%. And if you're 45, you need to save about 40% of your income to retire with $1 million. Now, saving can be tough. And you might say, here's the other thing. A lot of people will see these charts and they'll say, you know what? That'll never be me. So I'm not going to save. You know what? You have 50 grand saved or 100 grand saved. That's a great start. So keep saving. That's my tip. Now, so make sure you save a significant amount. Again, if you're 25, resolve to save a minimum of 10% of your pay. If you're 30, 15% of your pay. If you're 35, 20% of your pay. If you're 40, 30% of your pay. But if you can't save 30% of your pay, start small. Start at 3%. Start at 5. Start at 10. Get off of 0. Now, saving in a 401k plan may be tough for workers who switch jobs frequently. And after I return from the next break, I'll talk about this, a dynamic that's coming into greater focus amid the Great Resignation. But first, let's say you want to save for retirement and you don't know how to get there, or you've saved a lot for retirement and you don't know how to live off what you've had. Maybe you're worried about the stock market. Don't worry, be happy. Call my office, 888-988-JOSH, for the 45-minute wealth blueprint, 888-988-JOSH, 888-988-5674, 888-988-JOSH. And we're back. This is Josh Jalinski, the financial quarterback. Somebody said, is that $1 million of cash or assets? I want to say $1 million of cash. Because then if you have Social Security, you're at 50 grand a year. But hey, you can live frugally. I mean, my parents, they had a house in Whiting, New Jersey. It was like 25 grand they bought it for. So you can live on Social Security if you clip coupons, if you do, you make it work. You don't need much to be happy in the world. But you just got to be careful, okay? So give us a call, 888-988-JOSH. That was my wife calling. Oh, honey, I'm doing a show. So final segment this hour, saving in a 401k plan may be tougher for many of you, and research is showing that delays in saving, especially over lengthy periods, generally lead to smaller nest eggs for retirees due to how investment earnings compound over time. You notice the research isn't the market crashing. It's you not saving enough. It's you getting freaked out because your account went down 20%. 14%, this is according to a new report from Vanguard, which is among the largest retirement plan administrators, said that 14% of people saving in a 401k stopped saving but left their employer. So they didn't have money. Now, this is up from 10% in 2017. It includes individuals who left their company for another job or venture and those who retired from the employer. So that's another good tip. If you quit your job or your employer fired you, don't leave your 401k there. You're a free agent. You could move it to an IRA of your choosing. Now, 401k to IRA rollover is not right for everybody. So call us at 888-988-JOSH for my free rollover IRA guide. We go over who an IRA is right for and who it isn't for. Overall, almost 48 million people quit their jobs last year. This was an annual record. That torrid pace of voluntary departures has continued in 2022. There has been historic churn in the labor market. I want to say that has not been at Wealth Quarterback, our SEC registered investment advisory firm. We have a great team led by Jim, our illustrious office manager, and Tom Clancy, our CCO. And I just work there. So, but we've not experienced this churn. I mean, maybe a little during the pandemic. People were stressed out and stuff. But there's been historic churn in the labor market as job openings surged to an all-time high and employers raised wages at the fastest pace in decades to compete for talent, enticing workers to seek out new opportunities elsewhere. I hear this all the time from people who are landscapers or people who own a restaurant. I can't find good help. You know what? I found good help. We have a great team. So, good job, Jim. So, we were blessed. The mechanics of certain 401k plans. You know what I think it was too, though? A lot of employers during COVID, they just laid everybody off the day one. And I made a commitment to everybody, hey, we're not gonna lay people off. And thank God for that PPP, because it helped a lot of people. A lot of people gave people a hard time for taking PPP, but I think it really averted a big depression and people mass layoffs that would have really hurt the economy further. But if you look at PPP, and this is my biggest critique on PPP, PPP was like a $400 billion plan. Where'd the other $10 trillion go? Where did it go? Bridges to nowhere. So give us a call, 888-988-JOSH, 888-988-JOSH. There's a question on the chat room of what is better, holding something in a Roth or holding something yourself? Well, I personally believe holding it in a Roth because it grows tax-free, pulled out tax-free, whereas owning it yourself, there could be taxes when you go spend the money or there. So a Roth is always more advantageous from a tax perspective in a taxable account. So there's a lot there. So the mechanics of certain 401k plans mean that many new hirees can't continue saving in their new workplace plan right away. So if you get a new job, make sure you enroll as soon as you can in your 401k. And if your new employer offers a 401k match, take it. These funds may take years to fully belong to you. They may vest. Participants are changing jobs more frequently and may risk retirement savings interruptions. In 2021, 72% of 401k plans allowed new hirees to start saving immediately. That means 28% of yours did not. The remainder had a waiting period of at least a month before employees could save. 8% of them required 1 year of service. Many businesses also have a waiting period before paying a match. To that point, 62% of employers offered a 401k in 2021 began matching contributions immediately for new hires. Meanwhile, 18% required a year of service before paying a match. Those matching contributions, essentially free money from your employer, may not belong immediately to you though. Many businesses use vesting schedules to determine when savers have full access. Here's the thing. When I'm advising on a 401k for a company, we'll help your small business. If you need help with the 401k, just call me, 888-988-JOSH. I'd love to meet with you, shake your hand in person at one of our offices in New York, New Jersey, Long Island, Pennsylvania, Connecticut, or around the country via Zoom. And the key is many small businesses do this vesting. That's normal. That's in the employer's best interest. However, there should be no delay. If an employee wants to save and not get the match and get that tax deferral, there should be no delay. I understand a delay on vesting because you want to reward people who stay with you for a long time. I understand that. I understand vesting. I understand a lot of these things. I don't understand having a year waiting period or a month waiting period to let somebody defer their pay into an account for their retirement. So this is why we help a lot of people with educational meetings on their 401k. So we'll help you there, okay? Now workers can put up to $20,500 in their 401k accounts in 2022, and those age 50 and older can put an additional $6,500 away. Now dynamics are making it more difficult for workers who leave their jobs and accept new employment to continuously save for 401k. So my tip is, if you're in between jobs, keep saving anyway. Unless you can't afford it because you're broke. Then maybe you got to look at what to do with the IRA rollover. There are other ways to save for retirement outside of your workplace retirement plan. Workers can contribute to an IRA, for example. But IRAs, whether traditional or Roth, carry much lower contribution limits and generally don't have any match. So folks, if you want help on your 401k, because an estimated 48 million people just quit their job, how do these people live? They're basically, we are creating a nation of like a welfare state. Like, who has self-respect and dignity to make $2,000 a month on government benefits and EBT? I mean, I guess you could get by, but that's tough. But think about this right now. Think about it. If you're in New Jersey, we're in New Jersey, right? So Jim, you could say, I'm done. Hopefully don't do that. Don't leave me, Jim. And you could live on the government dole. You get free health care, you get free food, and you get a couple grand a month. And if you have no house, there's Council on Affordable Housing. You can get them to pay for your rent. So you can get like 50 grand a year in government benefits. But it's not really any type of life that I would want, or really most people would want. There's very little freedom there. But that's what's happening. We're incentivizing people to stay home. So here's the thing. If you're to make $15 an hour working for a landscaper, or sort of the equivalent of $15 an hour on, and by the way, now we have higher minimum wages. So if you get somebody, it used to be I'd give somebody a shot for $10 an hour, $8 an hour, whatever. I don't want to give, now we hire somebody with that higher minimum wage. We want to get somebody good. So a lot of unskilled labor, kids that need work, teenagers, people new in the workforce, also retirees, maybe that we're making, they want a little bit of spending money. You don't want to hire them. You only want to hire more skilled people, because you have to pay newer unskilled labor so much more. So what are we doing to our economy? It's like they're intentionally tanking it. Energy prices are rising. Taxes are rising. Everybody's feeling poor. What the heck? I don't really know when the average person is going to wake up. It's just, we gotta focus on fiscal conservatism, fiscal restraint. But here's the thing. I cannot control what happens in the White House. I cannot control what happens in the White House, but I can control where you put your money. You can control where you put your money. I can control where I put my money. What I mean is, that's called asset allocation. How much in risk versus no risk? How much in tax-free? That's called tax location. So you can control asset allocation. You can't control the market. You can control asset allocation. And then you can control your savings rates. You can control wisdom. You can be wise about your financial moves. So folks, give us a call, 888-988-JOSH, 888-988-JOSH. I want to thank you all for joining us. And if we have any room for further questions, you can come up to the stage now and ask your questions. as we finish up the show.
Hey, Josh, I'll ask a quick question that I put in the chat. So one of the things, like if you're an S corp, or like let's say you're an independent contractor and you're registered as an S corp, you have the ability to doing a Sep IRA, which, as far as I understand, lets you put up to 25% of your revenue. I would think that might be a better way of doing things sometimes, if possible, because I actually got hit last year with that excess funds thing, realizing that, wow, you can't put the $6,000 in, and realistically, $6,000 a year isn't very much to get you to retirement. And so, if you can generate a business that generates a significant amount of income, it would make sense to do a Sep IRA, I would think, to put that significantly larger amount into a retirement fund. Like your thoughts on that?
I am not a big fan of the SEP unless you didn't do proper planning and your accountant says that's the only way you can get a write-off. For small business owners, I prefer a solo 401k or a solo Roth 401k with a profit sharing. And here's why. You could do a Roth. I don't believe there's a SEP Roth, but you can do a Roth 401k. You can sock up to 27 grand if you're 50 or older, and it'll grow tax-free and you can pull it out tax-free. So with all this government spending, taxes are going to probably be higher. So I would merge a solo 401k or solo Roth with a profit sharing. And with the profit sharing, you could get up to like 60K as a write-off.
So what about those that are less than 50 though? What's the maximum contribution on something like that?
Less than 50 grand of income?
No, if you're do you say 50 years of age?
Okay, if you're 49 and under, you could sock away up to 20,500 in the Roth 401k or the solo 401k if you need the write-off. And then the additional, you could do what's called the profit sharing plan, and you could write off up to 60,000. So
good to know.
That's more favorable to the SEP. The reason why most small business owners do the SEP is that's something, the benefit is, let's say you want a tax plan for, let's say I met you, I've known you for a while, but let's say you came to us April 14th before tax filing. There's some things we can do now for last year's return. So let's say you did not do planning for 2021. The SEP you can sort of do after the fact. Some of these other things you have to do by the tax filing deadline. They've changed the rules on that a little bit, so there's more flexibility with it to cash. And there's a bunch of different plans. You could do a 401k, a Roth 401k, solo 401k, cash balance pension, profit sharing. Those are all better options than a SEP. SEP's not bad if you can't do the others. And we'll give a free audit to show you your options. Here's how much you can put in a SEP. Here's how much you can put. It's not that the SEP's bad. It's better than nothing, right? But because you get a write-off, and it may be, but they changed the rules recently that make the others far better than a SEP. So I hope that helps you.
So it's more of an afterthought then is what you're saying.
The SEP was usually done. You'd go to your accountant. Your accountant say, okay, you could do a SEP to lower your taxes. SEP's really designed like, you're like, oh, I didn't do any planning. So let's say you can do planning for 2022. You do the 401k. But let's say it's too late to do it for 2021. You can do the SEP. So the benefit of the SEP is you can do it after the tax filing deadline. You can do it after April 15th typically. I think they changed that on the other, but you have to have a plan document in place. But I have an actuary that we work with. His name's Brian, and he'll be able to make sure whatever you're doing is kosher. Okay.
Oh, good. Hey, I find it fascinating how our system encourages, or benefits businesses over over the general worker. Where as a business owner you can put in 20,000, but as an employee you can only put in 6,000. It just doesn't seem like it. It seems like it's put against the average person in general, which is kind of sad for this country.
Well, I would say this is how I would solve that problem. A regular employee could put in 20,500 into their 401k, but many just don't have the funds to do so. I think what would be a better, more practical solution would say, at your tax filing deadline, if you want to put more than the $6,000 IRA in, they could put up to $20,500 into an IRA. That way, if let's say it saved them 10 grand a year in taxes, or like in New Jersey, right, with state and federal taxes, if you put 20 grand in a 401k, you get an $8,000 tax savings. And some people, $9,000 tax savings. Now, you end up having to pay that back when you're retired, but if you don't have enough money saved for retirement, it's a great place to start. So, and with the Roth, all that money is growing tax-free. So, powerful question. Can a Sep be a backdoored into a Roth? Yes, but it's a backdoor. So you would do a Sep rollover to an IRA, and then you would put that into the Roth. But you got to be careful. I wouldn't do that alone. And we're here for you at 888-988-JOSH if you need help. Any other questions on that, David or Jay?
No, I'm
Yeah,
good.
I have I started with a SEP and now I have a Roth. No, and now I have a 401k with the profit sharing, but it's costing me for the administrator like 2,000 to 3,000 a year in fees. Does that sound about right to you?
I want to say our guy charges, like, I think he's a lot cheaper. But you can get administration service, I want to say $700. Are you in like a pension?
Yeah, it's one of those pensions where they do the the test for highly compensated people and all that.
I mean, you can write it off generally, but why don't you call us? We can shop it around with 3 vendors and see who does a better deal.
Okay.
Like
all
my
right.
guy, I don't mind paying him a fee because he's really good. So he can, I mean, some of these people, they're just collecting money. They're just collecting a paycheck. Some of them are actually helping you design and getting a greater write-off, helping your employees, all that stuff. So just give me a call, 888-988-JOSH, and leave a message if the phones are busy. And one of our wonderful team members will get back to you to schedule a 45-minute free Zoom session. So if you want a free 45-minute Zoom session and a free book, call us 888-988-JOSH. Okay, Jay, anything else?
So if I have a SEP that I did years ago, I just have to keep that separate then from the 401k, right? I can't combine them and just have one account.
You could combine them if they're all pre-tax, by the way.
Oh, I can. So I can roll the SEP into the other plan, huh?
Yeah, I don't. Can we roll Sep into 401k, Jim? I think so. But we'll call me and I'll check on that. But I think so.
All right. Okay. Okay. Thank you.
You can definitely roll a Sep to an IRA. I'm just gonna check Sep to 401k. I think you can do. It's called a reverse rollover. The traditional rollover is 401k to IRA, but you can also go IRA back to 401k. And the Sep is a type of IRA, so I believe you can do that. So,
I like the backdoor Roth, but the thing is, if your income's too high, you can't have a Roth and you cannot have a regular IRA, right? Even if it's not deductible. Is
no,
that
if
right?
your income's too high, you can do a non-deductible IRA. You get no write-off, and then you backdoor it. Then you
Okay, so
convert it.
regardless of income, anybody can do a non-deductible IRA.
Yes.
Okay, gotcha. Good news. Good.
We
good
can
to know.
help you with that. Give us a call, 888-988-JOSH. Some people will say you can't do that, but they're wrong. So
Okay.
I
Thank
think
you.
eventually they'll get rid of that, but they haven't gotten rid of it yet. So, which is a great way for people to do a Roth if they make too much money. So give us a call, 888-988-JOSH, 888-988-JOSH. You'll get a free 45-minute Zoom strategy session with me or in person. We'd love to hear from you. 888-988-JOSH, 888-988-5674. Want to thank you all for joining us. Follow me, follow the club. We'll talk more. This is Josh Jalinski, the financial quarterback, 888-988-JOSH.